Hello and welcome to another IFRS session with AARO. My name is Stella Chege, an IFRS consultant and trainer in AARO Academy. In today's session, we'll go through fair value measurements as per IFRS 13. In today's session, we will cover the following areas. We will start with what is the objective of IFRS 13. Here, we will answer the question of what is the purpose of IFRS 13. We will also look at the applicability of IFRS 13. Here, we will guide you on when are you required to apply IFRS 13. We will also cover the definition of fair value, and finally, we will have an overview of fair value measurements where we will cover the valuation approaches that are allowed under IFRS 13 and also the fair value hierarchy. Let's start with the objective of IFRS 13. The main objective of IFRS 13 is to define fair value, set out a framework for fair value measurement, and set out the required disclosures when applying fair value. So in a nutshell, it gives us the meaning of fair value. It gives a framework that guides entities when determining the fair value of an item and outlines the information that should be disclosed in financial statements when an entity applies fair value measurement. When is IFRS 13 applicable? IFRS 13 is applicable when another IFRS standard requires or permits an entity to measure an item at fair value. Many IFRS standard requires entities or permits entities to measure an item at fair value. For example, IFRS 9 requires an entity to measure an equity instrument that is held for trading at fair value through profit and loss statement. The guidance on when to use fair value is given by other IFRS standards, while the measurement of fair value is given by IFRS 13. So what do we mean by fair value? Fair value is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at a measurement date. So the key things are fair value is an exit price, meaning this is the price that is received to sell an asset rather than the price paid to buy an asset. 2, fair value is a market-based measurement. This means that when an entity is measuring fair value, they will consider the factors that market participants will consider when determining the value of an asset or liability. So they will look at factors such as location, the nature of the assets, and many others. 3, fair value measurement is based on an orderly transaction, meaning that there is adequate market exposure and the market participants are willing to participate and are not forced to participate. What should you consider when determining the fair value of an item? When an entity is determining the fair value of an item, it should consider the following. 1, the particular asset or liability and the unit of account. So is it an individual asset? Is it an individual liability? Or is it a combination of assets and liabilities, such as a business? The unit of account is usually stated in the IFRS standard that requires an entity to measure the item at fair value. The second consideration when it comes to non-financial assets, such as a building, is determining the valuation premise. Now, if you have 2 uses for this non-financial asset, which use will maximize the value of the asset? The third consideration when determining the fair value of an item is determining the principal market for that asset or liability. The principal market is usually the market with the greatest volume and level of activity. So for example, if an entity has access to 2 markets, the market that has the greatest volume of sales and the level of activity is the principal market. In the case the principal market is unavailable, then an entity can use the most advantageous market, the market that gives them the highest price. The fourth consideration is determining the appropriate valuation techniques. There are various valuation techniques that an entity can use. They can either use the market approach, cost approach, or the income approach. So it is important for an entity to determine the appropriate technique based on the asset and liability they are measuring. Let's now look at the valuation techniques that an entity can use when determining the fair value of an asset or a liability. It is important to note that IFRS 13 does not mandate the use of a particular valuation technique. Instead, an entity is required to use judgment when determining the valuation technique to use, and they should maximize the use of observable inputs and minimize the use of unobservable inputs. Now, what are the approaches that can be used in valuation of assets or liabilities? We have one, the market approach, where you look at the price or other transactional information of similar or comparable assets and liability. The cost approach, where you look at what you as an entity will incur to replace that asset. And 3, the income approach, where you look at the future cash flows that will be generated from that asset. That means that you will also include the time value of money, so you will need to discount the cash flows. Let's now look at the fair value hierarchy. We note that there are various inputs that go into the valuation techniques that are used to determine fair value. IFRS 13 categorizes these inputs into 3. We have level 1. These are observable quoted prices in an active market. So for example, the prices for treasury bills or treasury bonds. We have level 2. These are observable inputs other than those under level 1. So for instance, we have quoted prices for similar assets or liabilities. And we have level 3. These are unobservable inputs. So for instance, we have an entity's own data. The highest priority is given to level 1 inputs. These are the observable inputs, the unadjusted one that are quoted in an active market, while the lowest priority is given to the unobservable inputs. Thank you for listening in this session. We invite you to subscribe to our YouTube channel, and for a more elaborate and practical experience, kindly visit our website and register for our IFRS trainings. Thank you.